Hello, my friends. Today is May 10th, and this is Markets Weekly. So, this past week was a pretty eventful week in markets because we finally got Trump's first trade deal. And so now we have an idea of what trade deals going forward could look like. And as we speak, the US and China are having their first trade discussions in Switzerland, and the outcome of that will likely set the tone for trading next week. So, today, let's talk about the trade news we had the past week and some likely scenarios for trade discussions with China right now. All right, starting with the trade news. So last week, in typical showmanship fashion, Trump teased his first trade deal, and everyone was wondering who it was with. Turns out it was with the United Kingdom. Now, if you take a step back, it's kind of really curious to have any trade disputes with the UK. According to the US's own data, the US actually runs a goods trade surplus with the UK. So, from Trump's perspective, they are winning in the relationship. And of course, the UK and US have a long-standing close relationship. Now, the UK has been trying to get a better trade deal with the US for some time, ever since Brexit. Now, post-Brexit, of course, the UK doesn't have as good access to the EU market and would have liked to have stronger access to the US market, but it seems so this discussions really didn't go anywhere. So it was really, I think many people weren't sure just what a trade deal with the UK would look like, especially since you only had a few weeks to discuss. Now, everyone was waiting for the press conference to find out details. So let's take a look at the press conference.
The Prime Minister on the phone, and we were great allies in that. And it's very unusual that the trade deal comes due, and we signed it up on the same day that we had a great victory, the greatest victory of them all. So we are talking more and more about Victory Day because we were a big part of it, and so was the UK. And it's
just a few moments into that press conference, I could immediately tell by the look on the gentleman's face to Trump's left that this was a trade deal that was not in the UK's favor. Now, that man, he is UK ambassador to the US, and you can tell by his face that he just didn't really want to be there and he had no idea what was going on. And moments later, when the tariff sheet was released, you can kind of see why he was a bit bewildered. Now, the trade deal was very obviously in the US's favor. Now, what did the UK get out of this? Well, at the end of the day, the UK got, I guess, lower tariffs on autos. It would be able to export a large number of autos to the US without having to pay the 25% auto tariffs. Now, what kind of autos does the UK export to the US? Jaguars, Bentleys, Land Rovers, so stuff that Main Street Americans do not buy. But, they got that as a concession. What did the US get? Well, the US got more access to the UK markets when it comes to beef and ethanol. And the US asked the UK to buy more stuff from Boeing. And at the end of the day, the US is keeping its 10% tariff on the UK. Now, this is very important because later on, Commerce Secretary Lutnick will say this.
That sectoral tariffs are up for negotiation, but that 10% base rate is not.
Right. So reciprocal tariffs, if you think about it, is how open is your economy to our exports? How fair is it to our exports? What kind of trade deficit do you do? And that sets that line. So 10% is the bottom line for that. But as the president said, many of those will be higher. Of course, you can bring them down by opening your government, opening your economy to U.S. exports.
So it's very clear that the administration's strategy is that there will be a minimum global tariff on everyone of 10%. And this is something that this is something that I've been saying to my subscribers for some time. This is a fundamental change in the global landscape. Before Liberation Day, the US imported about $3 trillion of goods, and the volume-weighted tariff rate on those was about 3%. So going from, say, 3% to a minimum 10% tariff is going to have big implications on trade. It could go through consumer prices, it could go through currency, it could go through producer margins. So there's a lot of things that are happening through this. Now, if you look at the latest tariff data, customs data from the US Treasury, you can see that there's been a noticeable jump in tariff collections in April. And just eyeballing this, my best guess is that this is going to bring in, say, $200 to $300 billion extra in revenue this year, which will help with the deficit, provided, of course, we don't spend all of that on tax cuts. So this UK trade deal thing is really cementing to the world that this is going to be a new tariff regime, and this whole 90-day negotiation is just a way to strong arm other countries to give extra goodies to the U.S. For some degree of favorable treatment. Now later on, the FT reported some really interesting news, and that has to do with the China connection with the UK-U.S. deal. Now we've been discussing that the U.S. seemed to have a plan that it was trying to build a coalition of partners against China when it comes to trade. Now, earlier, Mexico had volunteered to put on tariffs on China, equivalent to the tariffs the U.S. puts on China. So basically building this giant firewall of tariffs against China. That idea seems to have run into problems because countries like Japan were not willing to rupture the trade relationship with China. Now, a pared-down version of this is appearing in the UK trade talks, where the UK now is asked to freeze China out of certain key supply chains like steel. So I think when it comes to defense going forward, the U.S. is trying to keep Chinese components, Chinese trade relationships out of its key supply chains, and ideally trying to keep that out of the supply chains of certain supply chains of its trade partners as well. So this is an easy discussion to have with the UK, which really doesn't have much of a steel and aluminum industry, but it might be more difficult to have with other countries. So again, trade talks with the UK were easy. Going forward, they're going to be much more difficult, and that's what Howard Lutnick is suggesting as well. It seems like he would like to have a trade deal with an Asian nation too, to have a template. Now, one of the things that I've been wondering is that whatever deal they have with an Asian country, is it going to have a currency component? Because I think there's a high probability that it could have, especially since a lot of the Asian countries have, I think, currencies that are relatively cheap against the dollar that really don't make economic sense, given many of them are exporting superpowers. And I'm not just talking about China. China is something that's totally separate. The markets really cheered all this trade talk. Now, Trump has been kind of a master at manipulating this. When I think back to his first term, he would always float out these trade talks are going well, and the market always responded well. Although I think that there is some limited runway to this. It doesn't always work. It's like any other drug. The first shot is the most potent. Later on, I think you lose potency to this. But at the moment, it seems like market participants still like this, and my best guess is that this all ends very poorly. But in any case, we have a first prototype trade deal with the UK. Going forward, we're probably going to get a lot more. And at the end of the day, it's going to look something like the UK as long as you're not named China. Now, the second thing we want to talk about is ongoing trade talks with China. Now, China is different from the rest of the world because the US views China as a strategic competitor, and also because China has a massive trade surplus with the rest of the world. Now, Trump has been saying for some time, yeah, we have talks with China, everything's ongoing, everything is great. But of course, we knew, reading between the lines and from the Chinese themselves, that there basically were no trade discussions. And we know this to be true now because the first trade discussions are happening in Switzerland this weekend. Secretary Bessent, U.S. Trade Representative Jamie Greer are flying over there, and it looks like they're going to talk with high-level Chinese officials as well. Now, just as I've been telling you guys that we're going to have minimum tariffs of 10% on the rest of the world, I think it's pretty well understood that at the end of the day, whatever happens with these trade negotiations, the destination is likely going to be, say, 50 to 60% tariffs on China. So right now, we're at 145%. That is obviously unsustainable. Everyone knows that. Trump is even saying that openly. So if you have 145% tariffs on a country, you're basically cutting off trade with that country. And that is not yet having significant economic repercussions on the US, but if they maintain it, obviously it will. Looking at the economic data, you can already see container shipments from China to the US basically plummeting. However, from the Chinese side, it looks like that decrease in exports to the US are being made up with additional exports to other countries like the European Union. So the EU is soon going to have their own problem dealing with a flood of cheap Chinese goods going into their shores. It's going to be much more a problem for them because they do have a pretty good manufacturing sector, especially in Germany. How are they going to compete with all these additional Chinese exports? They are already having trouble competing with the very good and cheap electric cars that the Chinese are manufacturing. But that's a problem for them. Now, back to the US side, we also see that there are increased transshipments happening right now. So that is China shipping to a third country, and then that third country shipping to the US. This was a technique they developed during the first trade war, specifically through Vietnam. Looking at Vietnam trade data, we see that Vietnam imports from China are increasing a lot, and exports to the US are also increasing a lot. So the businesses are finding ways to try to route goods, but again, this is not something they could keep on doing. So we do need to have some trade relief. Now, an interesting wrinkle is that Friday morning, Trump actually tweeted out that he thought an 80% tariff on China would sound reasonable. Now, 80% obviously is much higher than the 50 to 60% that everyone was expecting. So that suggests more of a hawkish tilt. He said that it'd be up to Secretary Bessent, but obviously when your boss is saying this, he's just being nice. So that's what he's at least publicly communicating to Scott Bessent. Now, on the one hand, this could be more of a hawkish move on the trade front with China, which I think would be in line with the administration's approach. On the other hand, he could just kind of be moving the goalposts such that when we ultimately have 50 to 60% tariffs come out this weekend, that would be perceived as dovish, and that would be positive for the markets and for sentiment. So I'm not really sure what will happen. The Wall Street Journal is reporting that China is sending their fentanyl guy over there. So it seems like the talks will be about include a fentanyl component, and that would be a reason for the US to lift their fentanyl-related tariffs on China. So I think a good outcome, the ideal outcome for the market from this would be for us to end up at 50 to 60% tariffs out of the meeting. Medium baseline outcome is for it to be 80% tariffs, as the president suggests. And the worst outcome, which I don't think is likely, but could be, is that this meeting occurs and nothing happens. Like tariffs still remain 145% on China. This would be a big problem for the US because I think at this time, well, at least in the coming weeks, we could expect inventories of businesses to be depleted. And at that time, we could really do have some shortages on shelves and potentially higher consumer prices or lower corporate profit margins. The Chinese, though, of course, I think would also like to have some relief on trade. It's not in their interest to have this huge 145% trade tariff on them either. They have businesses, they have workers that they want to think about as well. But I think the conventional thinking is that whereas this is hurtful to both economies, China is probably more able to handle pain than the US. But in any case, no matter what happens out of this meeting, the end result is going to be substantially higher tariffs on China, the US's largest trade partner. And this all is going to reshape the world. Again, this is a really big regime change that I think some people are beginning to understand, but others not yet. It's going to reshape businesses, and it's going to reshape capital flows as well, because say that the US is not buying as much from foreign countries. That means that foreigners have less dollars, and maybe they don't need to reinvest as many dollars into US assets. And so that could have implications for asset prices. And of course, ultimately, there are policy measures to deal with that as well. So far, let's pay attention to what happens this weekend. But at the end of the day, no matter what happens, I suspect that any relief rally or something like that is going to have to reckon with the reality that the economic structure of the world is changing. And that's just not going to be positive for asset prices in the US. All right, so that's how I prepared. And have a good week, and we'll talk next week.